If you don't understand how using multiple entity structures can work for you, you're probably overpaying a fortune in taxes. In this video, I'm going to walk you through exactly how to use the different business structures to dramatically reduce your tax bill, build long-term wealth, protect your assets, and gain financial control. If you're only using one entity, you're missing out on a powerful system designed to keep more money in your pocket. Hey, my name's Lloyd. I'm a CPA and certified tax strategist. Let's get into this. Let's look at why using only one entity type is costing you a fortune. The S corporation is great for reducing self-employment taxes, but there are a lot of additional benefits other entities offer you that you don't get in an S corp. What's the difference between somebody paying $800,000 in taxes and somebody paying $150,000? It's not revenue, it's structure, it's strategy, and it's knowing how to use a tax code to your advantage. Let's look at the Puerto Rican Act of 60. It provides an ultra-low 4% tax rate. It works best for a business and an individual that is not set on being in one location. It provides tax-free qualified dividends under certain conditions, and your personal income tax may be reduced to as low as 4% with proper planning. One of our clients, Sarah, moved her operation to Puerto Rico. With Act 60, she cut her corporate tax rate to 4% and saved over $250,000 annually. Because she met the residency requirements and structured her business correctly, she's now only paying 4% taxes. That's real money being reinvested in her business. But it's not just about lowering your corporate tax rate. It opens the door to structuring your personal income for maximum efficiency, potentially lowering federal tax exposure and creating long-term wealth advantages. Imagine what you could do with an extra $250,000. Pay down debt, scale faster, build a legacy, travel a lot more, and the longer you maintain compliant under Act 60, the more substantial those benefits compound. Next up, C Corporation. This is a great tax deferral engine. One thing that's nice about the C Corporation is the current tax rate is only 21% on the federal rate. This lets you keep profits inside of the business, not spending them all back out. It lets you do non-calendar year options for tax timing. That means you can move revenue from one entity to another entity and not have to pay taxes until the end of the next year. It also includes the benefits from Section 1202. You can potentially have a $10 million sale of a business and pay zero income taxes. You can use the extra retained earnings to grow your business. There's greater flexibility in fringe benefits and equity compensation. Take one of our clients, George. He needed cash to fund a major capital investment, but his S corporation structure would have taken 43% of the cash into taxes. He put the money into a non-calendar year C corporation. That saved him over $240,000 in taxes and eliminated the need for the debt financing he was going to have on equipment. One of our clients walked away with $8 million tax-free after just 5 years of proper planning. If you're planning to sell and not using a Section 1202, you could be missing out on one of the biggest wealth building tools in the entire tax code. One of our clients, Chris, didn't know about an investment that allowed for a Section 179 deduction. Once we identified the opportunity and guided him through the process, he was able to implement the strategy and increase his cash flow by $48,000 for that year alone. Another one of our clients, Mike, had an LLC. He was successful but had never made an S election. He was overpaying $32,000 a year in Social Security taxes. We ran the numbers and compared his expected return from Social Security versus investing the difference. Unless Mike lives to over 150, he's hundreds of thousands of dollars better off putting that money into investments instead. S corporations also allow for better control of how the owners are compensated. You can pay yourself a reasonable salary and take the rest as distributions, reducing the overall employment taxes. But these benefits only work when your comp is structured correctly and supported by documentation. Let's look at what we've been talking about. These are not minor tweaks. These are fundamental shifts in how your income is treated by the IRS and how much you ultimately keep. Next up, LLCs and real estate. Utilizing an LLC separates real estate from operating risk. It gives you the potential to generate passive income, includes debt and the basis for greater depreciation losses. One of our clients, Anthony, owned a short-term rental property and qualified under the special short-term rental rules. By using a cost segregation study, he accelerated depreciation and rescued $98,000 in income taxes on his tax return that year. That's a powerful strategy that many real estate investors overlook, yet it's completely legal and fully supported by the tax code. I mentioned that LLCs also provide critical asset protection. If your operating business gets sued, your real estate assets held in a separate LLC are shielded, and when structured properly, an LLC tax as a partnership allows you to use debt and increase basis. This unlocks larger depreciation deductions, enables you to shelter more income. Utilizing the LLC for real estate can be one of the most versatile tools available for business owners and investors alike. Next up is a Schedule C LLC. This is our family income strategy. This allows you to legally pay your children tax-free. You can take part of those proceeds and fund Roth IRAs for tax-free growth. You have to document the hours worked and make sure that you're paying fair wages. Some of the benefits: you're teaching your children financial responsibility early in life. It helps convert personal expenses into legitimate business deductions. Let's look at our clients, John and Sarah. They have 2 children who both work in their parents' business. They were looking for an easy way to help fund their college education. By using the family income strategy, they are able to pay their children tax-free and reinvest those proceeds into Roth IRAs. Over time, those investments grew tax-free, and by the time their kids reached college age, they had saved enough to cover their tuition. This strategy turned their business into an education funding tool. It taught their kids about finances and provided for long-term savings for them. And it gets better. And because the children were paid a fair wage for legitimate work, and the business got a deduction, the kids paid no income tax. And the money was invested in an account that grows tax-free forever. It's an incredible win-win. Just be careful to document everything. When structured and supported properly, this strategy can legally shift thousands of dollars in taxable income off your return each and every year. It's also important to consider trusts for asset protection and probate avoidance. They help protect assets from lawsuits and creditors, avoid probate court, maintain privacy with your assets, enables multi-generational wealth transfer, and can be used to reduce or eliminate estate tax. It also adds continuity in case of a severe disability or death. If you have significant assets, you don't want them tied up in probate court. With revocable and irrevocable trusts, you can ensure a smooth transfer of wealth without court delays or legal fees. More importantly, you gain control over how and when your assets are distributed. Trusts allow you to specify not just who receives your wealth, but under what conditions. Whether it's age milestones, educational goals, or responsible financial behavior, this can help prevent mismanagement and preserve your legacy. One of our clients, David, had $20 million of assets that would have been includable in his estate. Without proper planning, his heirs would have lost over $2.5 million to estate taxes and legal costs. With trusts in place, we cut that tax bill to almost zero. You work hard to build wealth. Why let poor planning or a coin-appointed process erode it? Trusts also ensure your wishes are carried out with minimal public exposure, which is really important for families who value discretion and long-term security. If you're running or in the process of running a $2+ million business and you're not maximizing these strategies, you're leaving serious money on the table. Money can be compounded for your future, not just lost to taxes. Feel like you're overpaying in taxes? You probably are. Schedule a free strategy with my team using the link below. Just 30 minutes could save you $100,000 or more this year. I'd really appreciate it if you like this video and share it with somebody else who could use it. Pay less, keep more. Let's get started.